Hi, this is John Coumarianos with Mindful Advisory. I wrote an article on a topic that we've been getting a lot of questions about, and that is how to take your retirement distributions once you've accumulated assets in your lifetime. It's a really tough question. The standard advice was given in 1994 by a financial advisor named Bill Bengen, who wrote an article, the upshot of which was you could take 4% of your assets the first year as a distribution and then change it every year thereafter for inflation, adjust it for inflation, and that would give you a high probability of not running out of money. I had the pleasure of talking to Bengen before I wrote this article for MarketWatch that appeared yesterday and did extremely well on the MarketWatch website. Bengen has revised his rule. He wrote a second essay in 2020 where he upped the minimum to 4.7%. So that's good news, especially after the past few years when low bond yields have caused a lot of people to think 3% was the new rule. Bengen said you can also be flexible based on two important factors. One is stock valuations, how expensive stocks are, and he uses the CAPE ratio. Some of you know what that is. To assess that, the CAPE ratio is the current price of the S&P 500 relative to its past 10-year inflation-adjusted earnings. On that metric, stocks look expensive, historically expensive right now. Nobody really disputes that. There's some argument that they should be more expensive since companies are more profitable, but nobody disputes that the historical number is high now. The second factor is judging inflation. Hard to do. We've had much more inflation in the past few years than we have had over the past 40 years, although we've gone from 9% a little over a year ago down to about 3.7%, I think was the last reading we had. In any case, Bengen thinks this is the worst environment based on inflation and the CAPE ratio, combination of those two things, that we've had in 100 years. And so his advice is stick to 4.7% as your distribution in the first year and then adjust it for inflation thereafter. He has one other important piece of advice that I haven't heard other people say. He says if you're a retiree and you're accustomed to having a balanced portfolio, roughly half stocks and half bonds, or let's say 60% stocks, 40% bonds, that's what usually counts as a balanced portfolio. What you should do is lower your stock exposure, and he thinks you should lower it significantly to about 30%. So that's really cutting it in half. And he thinks that's because an expensive stock market gives you a higher probability of suffering a crash in the early years of retirement if you're, say, 65 now and you're retiring this year or in the next couple of years. And that can be catastrophic for a portfolio to suffer big losses in the early years of distribution. And so he'd like to see investors who are in the early years of retirement or just retiring tone down their allocations. Take the 4.7, use that rule, but tone down the stock exposure. I will post a link to the article in the notes to this video on YouTube, and I hope you enjoy it. This is John Coumarianos with Mindful Advisory, signing off. Thanks very much.